Just in case you are already here waiting in the lobby, we will be starting in roughly 7 minutes. Thank you very much. We'll talk to you soon. Alright, we'll be starting in about 2.5 minutes. Thank you for sticking with us. Thank you so much. Apparently I've been running on mute here. So let's start this from the very top. Thank you very much from my beautiful wife for telling me that I was on mute for, let's say, I don't know, 12 minutes. Okay, cool. All right, now that we're actually here and you can actually hear me, let's start from the top. Aloha and welcome. I'm Colin Edsman, the host of The Week That Was. I'm going to skip past some of this just so we can catch up on a little bit of time because I was on mute. So let's skip to the stories for a bit. Now we'll do a really quick rundown. The Fed held rates steady Wednesday, but 3 regional presidents dissented wanting a hike. That's not nothing. Microsoft ripped 15% on blowout numbers, Meta beat revenue and still got hammered 8%. Amazon jumped 15% on cloud strength, and Thursday the market just erased Wednesday's fears in a single session. Dow up 613 points, S&P 500 up 1.7 points. Now, let's go over some quick housekeeping. I'm going to run through this real fast because I'm now 12 minutes behind for being on mute. I'm not an investment officer. I'm not licensed to do this. This is educational and entertainment, basically. But if you're here to listen, remember, go find a professional if you like anything you hear and double check with them. All right, so we're also going to be checking on the agentic desk, seeing how they performed this week, and we also shut down an entire sleeve out of that. But if you're new here, I'm here every Friday. I run through the week's market stories, break down the bigger narrative underneath the headlines, and then give you a full update on the agentic portfolio, like I said, what the agents did, what worked, what didn't, and where we are watching next week, whether bullish or bearish. The portfolio itself works automatically. Now, where are you from, Chad? I want to hear it from you. Thank you so much for your help. I really appreciate it. But wherever you are, whenever you are, yeah, just leave me a comment in the chat. And obviously we got some studio gremlins here, so if you're still around while you're watching me basically talk to the air for 12 minutes, let's get into the top stories. Story 1, the Fed decision, and it's more interesting than no change. Wednesday, the FOMC voted to hold the federal funds rate at 3.5 to 3.75%, fifth straight meeting at this level, lowest it's been since 2022. On the surface, that's pretty boring, sort of expected, and definitely priced in. Markets had it at better than 75% odds going into the meeting itself. Here's what wasn't boring though. The vote wasn't unanimous. It was a 9-3. 3 regional Fed presidents, Beth Hammack out of Cleveland, Neil Kashkari out of Minneapolis, and Lori Logan from Dallas, dissented, and they didn't want to hold. They wanted to raise rates a quarter point. Right now, because inflation has been sitting above Fed's 2% target for more than 5 years running, and they don't think a hold is enough anymore. So here's the reason that matters. A 3-vote hawkish dissent at hold meeting is a real signal. It tells you the committee isn't unified, and they're having a bit of a family fight here. It also tells you the inflation fight obviously isn't over, even though the Fed Chair Kevin Warsh has been notably quiet on forward guidance. He's new. We've got to give him some time. He didn't even submit a dot plot projection back in June. First chair to skip that since 2012. That silence is its own signal, but we're going to have to deep dive into that later. Markets are now pricing in 2 25 base point hikes sometime in this year. Not cuts, hikes. That's real repricing from where sentiment was sitting even a month ago. Now, from my perspective, this is not a raise the rates are going to go up situation anymore. If you're positioned for cuts this year, this week told you to rethink that, and hopefully you're doing so. Rate-sensitive sectors, real estate, small caps, high multiple growth need to be watched more carefully into the year's end. And every FOMC blackout window we run into at the Kairos desk, because they don't trade during these kind of meetings, just got more important, not less, because of the amount of wishy-washy signaling we're getting here. And, well, like I said a few times already, dissent. Now, if you're in the chat in any of the few places that I'm live streaming here from, did you expect that many hawkish dissents? Drop your read. I want to hear what you guys think. Now, here's our next story. And this one, well, this is the one that actually moved the markets this week. 4 of the Magnificent 7 reported in a 48-hour stretch. Microsoft and Meta on Wednesday, Apple and Amazon on Thursday. Alphabet had already reported like a week ago, or a week and a half. Now, Microsoft up 15%. Azure grew 43% over a year. That's the number that mattered for them. Real, external, growing cloud revenue that investors can point to and say, yes, AI spend is converting into dollars. Now, if you've been following this show even a week, we've been talking about how now AI has to show us its receipts, right? We're at the show me the money phase, right? AI needs to show us what it's going to do. Can it be profitable, right? Can it turn what would have been human working hours into seconds working on a prompt on an AI, right? And can that turn into actual money? Now, Amazon, same story, up 15% because Amazon Web Services grew 37% year over year. Beat expectations on the cloud arm specifically, and the stock ripped. Now, everybody's gonna have Amazon forever, blah, 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 whatever. But Amazon Web Services, they always kick us off, right? I mean, I'm not 100% sure if Robinhood is still utilizing AWS for services, but every time there's some sort of rip or some sort of crazy thing going on in the market, we get blocked out. So, on a personal note, not a big fan of Amazon. Now, let's get over that and go into Meta. Meta is actually down 8%. And here's the part that should kind of pause you for a second. Meta beat. They didn't, do poorly. Revenue came in at $60.8 billion against expectations of only $60.22 billion. Revenue growth 27% year over year. A genuine beat. And the stock still dropped 8%. What does the street want anymore at this point? It is hard to gauge, to put it simply. But honestly, what are you gonna do? The street wants what the street wants. Now, Apple also beat estimates on both sales and profits, though its reaction was far more muted than Microsoft and Amazon's. So what's going on? Well, here's what I think. It's not about who spent the most on AI, it's about who can point to a metered external revenue line that's actually growing, because that's the bottom line. That's where the money's coming from. That money needs to be made here, right? Microsoft has Azure, Amazon has AWS. Both showed clear, measurable returns on AI infrastructure investment. Meta and Apple, well, they couldn't demonstrate remotely close to the same thing, and their AI spend is real. They are spending millions, probably billions of dollars on AI spend, but the market can't see where the incremental dollar is landing. So for every dollar that they spend on AI, investors want to see how much they're recouping on that dollar, right? That should be we should just have an AI spend metric at this point on top of Robinhood, underneath the company. If they're using AI or spending it all, how much are they making per dollar of AI spend? Compute it to token. No, you know what? Don't compute it to tokens. Just leave it the dollar. But here's where I'm coming from here. We moved past the phase where we're investing heavy in AI, and it's fine. Don't look at whether it's making money. No, we can't go forever that way. That time is done. The market now wants proof of return, sector by sector, company by company. That's a healthier market long term, but it's much more selective in the short term. And it means dispersion between mega cap names is going to keep widening, I guess, not narrowing at this point. Like, even a small little caveat, we're seeing the SPY deviate from the QQQ at this point, and that hasn't happened in, a long time. Like, I saw that on a post today. If I happen to find the actual data point, I'll bring it up later on in maybe next pod. But that little deviation between the SPY and QQQ, from my perspective, tells me that the overall SPY is 500 of America's best companies, and only the top few are AI. So the rest of the, let's say, 490 or so are regular, maybe consumers, energy, real estate companies, like companies that are growing without AI. So because of the Qs being, mostly tech's getting hammered, but the rest of the S&P 500, or at this point, S&P 490-ish, is holding up the rest of the market at this point. Now, we need to really see where the AI spend is going to go and how it's going to turn into actual dollars for everybody. But let's get into our next story. Because of the, gremlins that delayed the first 10 minutes of this podcast. Now, Wednesday's sell-off, Thursday's rip. Oof, my gosh. Here's our next story. The whiplash and the number hiding underneath it. Let's talk about the 2-day swing that we had, because it was violent. And we're not even sitting in a high VIX area. Pretty low considering what some of the VIX numbers have been this year. Monday into Wednesday, the market was under real pressure. AI-related tech names sold off hard as investors questioned the sustainability of the massive capex being poured into AI infrastructure. This was the setup going into Wednesday's Fed decision and Meta's post-earnings drop. Then Thursday comes along. Full reversal. Dow Jones jumped 613.92 points, 1.2%. Closed at 52,208.06. The S&P 500 gained 1.7% to top off at 74,000. Wow, imagine that on the S&P. No, 7,437.63. All major indices finished green. Semiconductor stocks specifically bounced back hard after Microsoft's blowout results and upbeat forecast erased fears that AI spending was, unsustainable. That's the real relief rally that we're looking at here. The Fed's, they're holding steady, regardless of, the infighting that they're dealing with. Combined with Microsoft proving AI infrastructure spend can actually convert into money needs to be made. We want the receipts, right? If you're an AI investor, you want to know they're making money. Okay, rule 1, your company you're investing in better be making money. And if they got AI spend, they definitely need to be making money off of every dollar spent on AI. And if they're not showing it to you, that company's definitely going to take a hit during their earnings. Not investment advice, not financial advice, but obvious advice. A little bit. Make sure your company's making money, huh? Jeez. But here's the number that got buried under all of that. Q2 GDP grew 1.5% annualized. The forecast was roughly 2%. That's a real miss on growth. Landing in the same week the Fed just told us inflation is still hot enough that 3 voters wanted to hike. Well, from my perspective, here's why that matters. Soft growth plus sticky inflation plus divided Fed is not a comfortable combination. It's a setup, it's the setup people use for the word, oh God, I hate this word because it's so dumb, stagflation. Ugh. There, I said it. But even if we're nowhere near a 1970s style version of it, the market chose to celebrate the AI earnings story on Thursday and mostly ignore the GDP print. That's fine for one session. It's worth watching whether that keeps happening though, because we can't keep ignoring that. But as far as takeaway goes, don't let any one Green Thursday erase what actually happened this week. We got a hawkish-leaning Fed, a growth miss, and a market that's becoming much choosier about which AI names it rewards. That's 3 separate reasons for a two-way volatility heading into next week. Not one clean signal in either direction. Alright, chat. Any chat. At any time. Are you more worried about the Fed or the growth number right now? Drop your take. I really want to know what's going on in your heads. Now, before we move forward into the next segment here, I'm going to just double check all of the feeds are working out. It seems that YouTube has got my audio. It seems my audio is working here on X. Yep, perfect, that's working. Let's check this. Alright, that seems to be working as well. Now, we are 20 minutes into the pod. Now, usually this would be the end of our stories, but I got a couple of bonus ones for you, and you're really going to want to hear these. So, if you were in the markets at all this week, this isn't going to be a news story for you. The Leopold Aschenbrenner blow up. Oh, and we're going to talk about some of Robinhood's earnings this week. But I covered some of that in the live earnings podcast when they actually printed and spoke. But I'm going to need you to buckle up for these two, though. Whew. All right, so Leopold Aschenbrenner. If you've been anywhere near AI investing Twitter the last 2 years or so, you know the name. Former OpenAI researcher wrote a viral essay called Situational Awareness, turned it into a hedge fund of the same name and grew it to roughly $20 billion in assets and returned 439 net through June. You're seeing where I'm going with this, right? But by making concentrated high conviction bets, predictions on AI build out, we're talking about chips, power, infrastructure, the whole stack. This week, that fell apart, and hard. Reports have the fund's assets sliding from around $45 billion in gross exposure down to roughly $10 billion in a matter of days. On top of that, it was his wedding week as well. Congratulations. Sorry this happened to you this week. Leopold's definitely taken some hits, but back to the story that matters. So, in a matter of days, after losing about 67 billion or 67% of its value in a single month on falling semiconductor stocks and mounting margin calls, yes, even billionaires get margin called. Also, stop using margin. You don't know what you're doing anyway. Just don't do it. But Thursday's Situational Awareness sold off its entire levered book of public equities in one block trade. And the buyer was, surprise, surprise, Citadel Securities' Ken Griffin. He scooped up that position. Talk about timing. And also Citadel Securities was the one who had reported that the Fed would do a surprise hike. We all knew that wasn't going to happen. This isn't the environment for a Fed to even see what to hike. We're still dealing with the Strait of Hormuz. Dang, I was hoping to get through one show without having to say that stupid place. Not a stupid place, just tired of talking about the damn Iran war. But I digress. Let's get back to Ken Griffin. Griffin's Citadel. Well, Citadel scooping it up. this is the same time Microsoft and Amazon prove that AI trade is still printing money, right? Or at least producing revenue here. And in that exact same moment, one of the highest conviction, most concentrated AI bulls on Wall Street got forced out of his own book by leverage and margin calls. Take profits, huh? Why are we here? Take profits, huh? Gosh, leverage. He was reported to be at like 4 times leverage on 40 billion, 46 billion. Why didn't you deleverage when you started? Okay, I'm not gonna tell this 25-year-old what to do. He obviously knows what he's doing. He's already trying to raise capital again to do it again, but he won't be using margin this time. Yeah, that sounds like an alcoholic trying to say this was my last drink. Let's watch him blow up another portfolio on something ridiculous. He's gonna just be like the opposite of Michael Burry, the overbull. You gotta stop being delusional at some point, right? Someone blows too much smoke up your back. Yeah, that works. And then you just got an overinflated ego, and your hubris, maybe arrogance, will take advantage of you. And it took advantage of him. Now, let's get back into this. The AI trade being real doesn't protect you from being too levered, being too concentrated, or being too early, right? Being early and being wrong are roughly the same thing. Aschenbrenner is getting married this week. Like I said, this weekend. He might be getting married right now for all I know. I don't know what part of the world he's getting married in. But chief of staff to Anthropic's CEO is the person he's marrying. I want to say her name is Avital Balwit. Correct me if I'm wrong. These are obviously foreign names. And even as a, native-speaking individual, Hawaiian and German and, wherever Avital is from, I don't speak those languages. My mouth just doesn't function that way. But it's a wild week to be walking down the aisle. Imagine that, getting margin called. Who knows what he had to do? I don't know. I'm seeing all kinds of stuff happening. But have a great wedding. Sorry about the crazy week. But here's the takeaway from my perspective. Conviction is not the same thing as risk management. Duh. You can be right about the macro story, AI infrastructure demand, in this perspective, and still get wiped out if you're leveraged into a drawdown, right? That's a lesson for anyone running size, not just billion-dollar funds. Okay, here's the second bonus story. And it's a big one on a couple of fronts. So, Robinhood reported earnings on Wednesday. That's the first part. EPS of 62 cents against the estimates of 45 cents. A real beat. Revenue came in at $1.31 billion. 1.31 billion, up 32.3% year over year. Also ahead of estimates. It's a record quarter. 22 billion in net deposits. Adjusted EBITDA of 741 million, up 35% year over year. A 57% margin, which is great as well. The Trump accounts that they manage, which is it's a product of theirs, but it's more of a generational wealth engine is how I like to think about it. But that product has pulled in 77 million signups and over 1.5 billion in contributions. The one soft spot, though, crypto revenue is down 38% year over year. A reminder that trading volume-driven revenue lines swing hard both ways. Stock moved higher on the print, though. As far as the crypto narrative goes, it's not necessarily the same on the opposite. On the micro end. The macro might be, let's say, not so revenue driven. But here's our second part of the Robinhood story. And this is the one that matters more long term. We're going to talk about Robinhood Chain for a second. Now, if you've been sitting here in the chat looking at sitting here in the chat looking at YouTube, you can kind of see this bad boy right here. Now, if you're anywhere else, sorry, you're going to have to kind of see what I'm talking about. But Robinhood Chain, which is a blockchain, they launched their own public one. It's a base layer 2. They launched it July 1st, built for 24/7 tokenized stock trading, and plugs directly into DeFi. Partners on it include Uniswap, Chainlink, BitGo, Alchemy. They've already rolled out Robinhood Earn as well, which is a lending product, giving you 7% APY on stablecoins through Morpho. Yeah, through Morpho. Adoption numbers are, they're real. Close to 800,000 lifetime active addresses. That's roughly 838 million in decentralized exchange volume in a single 24-hour stretch. The chain has moved more than, triple. I think it's tripled in size since July. But don't quote me on that one. That one is more of a bullish guess. But here's an honest caveat, because I'm here to keep it pragmatic. Despite Robinhood's pitch of regulated serious revenue for tokenized real-world assets, the actual tokenized stock activity on the chain is still pretty small. Roughly 70 million worth by the end of the month, which we're sitting at right now. What's actually driving volume right now is meme coins, like Taco. That is all I'm going to say about it, because I'm going to deep dive into Taco probably later on in the week, give you a full breakdown on, a meme coin that's designed by someone who isn't an idiot. Yeah, we'll go with that. But what's actually driving volume is the meme coins, like I said. So infrastructure is real and growing fast, but the trade any stock 24/7 on-chain vision is still mostly a promise rather than current reality. From what I know, the tokenized stock is sort of a placeholder for the actual stock. It moves one-to-one with the stock price that it's representing. But it's not a share of the company per se. It's sort of renting the share from a company that's holding the actual share, and you're getting a blockchain holding ticket for it. So when that holding ticket is transferred to another wallet, they can then redeem it for, whatever stock token, whatever stock is represented by that token. I think. Yeah, you can quote me on that. I'm pretty sure that's right. That's my look on it. As far as use case goes, I'm not 100% sure what the use case would be. Also, I'm not sure why there's music playing. Hold on one second. Let me figure that out. Am I talking guys with music on this whole time? My goodness, someone could have let me know. They're still playing? Yeah, they're still playing music. Where is this music coming from? Hold on a second, gang. What a crazy show today. All kinds of stuff going on. Wow. Well, I guess... interesting. Alright, so now we're playing Where's the Sound Coming From? So, give me a second. No, it's not there. I don't even know this song. Oh man, what a crazy podcast today, huh? Well, this is the week that was, a podcast where the host cannot find where the sound is coming from. Alright, we're cutting some lines here. Where is that coming from? Wait, it was coming from X's end? Why would they play that? Ugh. Yeah, I'm not going to do that if you're going to play some crazy music in the background. But we're going to move on now that I figure out where the dang music was coming from. Crazy. All right. Well, I don't know how to check that next time. I'm going to have to keep my eyes up. How am I supposed to know that random music's playing from a random window in my computer? Ugh. All right. As you can see, this is a one-man job, and, well, I make a lot of mistakes, but we do. That's how it goes. I hope you liked the score that was going on behind my voice, and, well, if it was better, leave me a comment in the chat. If you like that better than me just talking out without a score in the background, we'll do that. Why not? Now let's see what else I can get back up and running while I'm thinking about it. Ugh, what a wild day. My goodness. Hope you guys are doing okay. Thank you for tuning in and sticking with me through all this. Nonsense is nonsense. Gremlins are gremlins, and that just happens sometimes, right? But okay, let's get back into it. Here's sort of why I'm covering a lot of different things, right? The Kairos, they watch all this too. They watch the same things we do, right? A lot of even the script that we try to use here on the week that was is fed into AI so they can utilize it for next week's, well, predictions for themselves. We try to execute every trade we can. I mean, I use Kalshi, but all of the actual equities trading and all of the, well, crypto trading is all done through Robinhood. The platform itself is having a transformational quarter, right? They're going from just purely crypto volume to a long-term investment company, right? Retirement, Trump accounts, managed accounts, custodial. They also got trust accounts that are now available and rolling out to some people. Record earnings plus a genuine new business line in tokenized assets that's directly relevant to the infrastructure our entire operation runs on. It's worth watching whether Robinhood chain adoption broadens beyond meme coins in, well, the later half of the year. I don't see why that's necessarily important because, well, the blockchain is good for meme coins, it's good for altcoins, it's not as good for tokenized stocks quite yet because, well, we have the stock market, right? And if it doesn't necessarily represent the stock directly, shareholder wise, voting rights wise, then it's mostly just a placeholder that you should redeem as soon as possible, right? So, what's the point of it being tokenized if it doesn't matter a whole lot? Well, you leave me your thought about tokenized stocks, and we're going to get into the market movers. So Dow Jones up 613 points, S&P 500 up 1.7%, semiconductors broad bounce on eased AI spend fears. Microsoft up 15%, Azure 43% year over year, Amazon 15%, AWS 37% year over year, Meta 8% beat revenue, 27% year over year. Apple beat estimates on sales and profit, but had more or less a muted reaction. The macro, obviously the FOMC held at 3.5 to 3.75% with a 3 to 9 vote, 3 hawkish dissents. Q2 GDP 1.5 annualized versus 2% forecasted. A miss, but that's not a huge miss, but a miss of almost 0.5%. Brent fell near 4% Monday to $96.78 a barrel. WTI down 3% to 89.31. Continued pressure from US-Iran de-escalation headlines. Whether that's going to be a taco or not, I don't know. As far as the taco index goes, this weekend we got about a 40% chance he pulls back what he said. Doesn't seem like that's going to happen. President Trump is determined and boots are on the ground, unfortunately. So whatever's happening over the weekend is probably going to happen. Now, directly hitting our own energy position this week on the Kairos desk. More on that in just a second. But here's my read. This wasn't a one-directional week whatsoever. I couldn't read it if it was a one-word sentence. Rates repriced hawkish, growth came in soft, the AI trade fractured into winners with provable ROI, and well, everyone else. That's the market doing real work to reprice risk, not a market that just decided to go up or down. Now, before we get into the deeper angle, I'm going to take just 30 seconds to make sure everything's working, make sure there's no more sounds randomly happening. Thank you for sticking with me, even if you've gotten remotely this far. I promise, we'll get into something more interesting here in just 1 minute. Stick around. I checked whether I was on mute that time. Now, let's get into the deeper angle here. Let's go down just one level. What the actual story underneath all this is. Here's the narrative I'm watching, and I want to be direct about it. The market spent this week demanding proof of ROI, and so did we. Microsoft and Amazon didn't win this week because they spent the most on AI. They won because they could point to where the money was coming from, that the AI was actually turning into something and making profits. That's the market doing something healthy, right? Making the AI spenders prove that they're making money for the investors on all this AI spend. Everybody gets good credit for a little while, but eventually you gotta show receipts. We did the same thing on our own book, right? Well, the agents pulled it off on their own, right? I kind of had to lean back and be like, okay, the agentic portfolio manager, you take it over. If you think we should do this, we should do this. And so sleeve 2, our ETF rotation strategy, we launched it on the 23rd with everything else. We fired that SOB. It just wasn't working. It just kept not running correctly. It wasn't reading it correctly. And it might have been just the wish-washy month that we were trying to run this sleeve in. It couldn't pick a right choice to save its life. So, with 28, well, maybe a little bit less, maybe 26 or so % in realized losses just in that particular portfolio. But no kill switch was ever switched. Nothing broke. After 5 weeks, it just hadn't proven any edge as well, right? I just kept having to fight with it. So rather than just let it sit in stasis, waiting for a good month for it to work, I just made the call, and the agents made the call. You just got to reallocate the capital. We do that in our own portfolios, right? We have a strategy and a plan, and that plan doesn't function. Now, we can't force that plan to function. We just have to adapt, reallocate, lick our wounds, and continue on moving forward because the capital would be probably better spent than just sitting there, right? That's not the reason. If you want it to sit there, we can put it in the Robinhood Lend at 7% and have it just sit there and grow. Right, we're looking for an edge here, and I need to make sure that these agents, well, create one or find one. So that capital moved into the wheel income strategy. It's an option strategy. If you're not familiar, well, go look it up. I told you that last week. Hopefully you already did, because now we're really going to deep dive into it just a little bit, right? So the wheel income is running covered calls and cash secured puts on names that everybody could afford, like Open and NIO. Now, I'm not a big fan of NIO, mostly because it's an ADA, so I don't really like getting into international stocks a whole lot. But I'm letting the desk do its thing, right? I don't want to micromanage these make-believe individuals. That's the one part of this desk that's actually shown other than options trading that I use to kind of just keep growing capital. But that's the part of the sleeve strategy that's producing steady income without using too much compute. Regardless of what the broader tape is doing, we scaled up some of the allocation towards that sleeve. About half the account actually is moved now towards there with the firing of, well, I don't remember what agent we fired. Doesn't a whole lot matter. But we're up about half from a quarter. We're roughly up about 25% from before. But so the desk itself is working. It's not running on hunches. It's the same logic as Microsoft and Amazon. It just got rewarded for proving that it could make money, right? So since those sleeves made money, I kept it going. Since that sleeve didn't make money, I cut it off. Now, in the broader market, we obviously can't just cut off a big ass company and be like, hey, you're not making enough money on AI, cut. No, we can't do that with companies. We have to, well, show them through the stock price drawdowns, right? And a couple of companies got that hit this week, as we were talked about already. The other half of this story is the Fed versus growth tension, I guess. A hawkish leaning Fed with three dissenters wanting to hike, sitting on top of a GDP print that's missed on the downside. That's not a setup that resolves cleanly in one direction whatsoever. It means the next several weeks are going to reward discipline over conviction. Now, I always promote discipline. That's the best way to go. But do you, right? Do your trading. But at the end of the day, once you've been here long enough, you know discipline over conviction. Any day of the week. Conviction is just a long word for hope. And hope is not an investment strategy. Just remember that. If you take away nothing from this episode, hope is not an investment strategy. All right, thank you. You don't marry the thesis because the story sounds good. Well, we're watching all this from Hawaii, outside all of the actual noise. This week, the lesson wasn't a stock pick itself, it was a portfolio construction lesson. The cut, well, it isn't working when, well, at the end of the day, what isn't working, even when nothing is technically broken, is still sort of broken if it's sitting there idle, right? So I'd rather just scale. That's not necessarily the most exciting content, but that's the job, right? We reallocate, we adapt. Now, let's get into the nitty gritty of the actual desk itself. right? So we're up about 2% on the week, 2.17% on the week for the Agentic portfolio. Day to day, it was bumpy. Monday up 2%, Tuesday down 2%, Wednesday up 2.5%, and then Thursday down about a third percent. Today was basically flat, right? So just like the rest of the market, the agents could not pick. Well, I mean, they didn't make the best picks either. So as you can see, the agents are more or less working on the same information as the rest of us. So it's not going to be the best at picking because it's using the same input as we are. But it's the best at being disciplined. It's the best at cutting the losers sooner and taking profits when they're running, or at least ratcheting up the stop losses. So the trades that closed this week was the XLE energy sector, right? So that was a winner. Not up a whole lot though. It was only like a 0.5%. We kind of had to cut it because it's been held since, well, July, mid-July, and it was just a little on the long side. And it was sitting right on top of its stop when energy got sold off Monday, so it made the most sense to the desk itself. Oil closed down to 4%. XOM and CVX both down 2%, plus or ish pre-market. So our our CIO for the Agentic Desk flagged it as a live exit recommendation with the FOMC's decision 2 days out from that point. The desk closed it Monday for a small clean win, but it wasn't a big number, like I said, but exactly the kind of disciplined exit that keeps the losses small, especially if it becomes, well, a actual drawdown, right? Because then our stop loss is actually triggered. Basically, we came in flat on that position. Now, there was some calls that they made sort of during the meeting itself. Now that I was a little sketched out about because that's not really the don't trade or blackout that I was considering for this desk. IWM calls that they had for the August 7th expiration, um, they bought it and it dipped and they took a 10% loss on that thing. Wasn't a big fan of it, mostly because they shouldn't have done it. But they put in some puts on the other side, 285 puts for the same IWM, expiring the 31st or today. It was sort of an event hedge, and that thing like blasted and ended up running, let's say, 35.1% profit. Now that one was fun but sketchy, right? Because I kind of had to get the desk to watch that particular short expiring option more often, right? Because I don't because of the volatility of an option, especially when it's an option that expired a day or two from the time that it bought it. Oh man, like I'm like a coke addict watching those kind of short expiration ones. Like I don't just tend to do that personally anymore, but the agents felt like it was a good hedge and it worked. But I had to tell them to watch that trade and check on it like every 10 minutes. Like, so I just added a caveat to one of my agents telling it to watch this particular position every 10 minutes if it's expiring this week or within the next 5 days, right? Just watch it just because it's going to swing more violently. The theta decay is way more rapid the shorter, closer to the expiration you are, right? So once you're in profit, take it off the table, right? Just like it's like an inventory thing, right? It's or if you're in retail, if somebody wants to buy something, sell it to them. Don't wait for it to be worth nothing to nobody because you're hoping to sell it for more. No, somebody wants to buy it, sell it, right? Be reasonable. And well, the desk itself, the agents knew what they were doing, even though I had to kind of tell it to watch it more vigorously. It still pulled that 35% profit on that position, which was kind of enticing as far as a programmer goes, because I like that kind of size, right? It wasn't big, but it was a lot of compute. So if it's not going to work like that all the time, it's going to be running through tokens without actually making any money. I can't guarantee it's going to make a 35% profit every time, right? That's crazy. If that was the case, everybody would be rich. So because of it was more of like a binary trade, or a short fused event trade, the sizing and the trade or and the expiration sort of had to line up correctly for the agents to pull the trigger. Now, there's an open position that they have, not open door, the open position that it has that isn't necessarily, well, options covered or part of the wheel is actually Coca-Cola. And who doesn't love Coca-Cola? Now, it's been held for a little while now. It's got about 40 shares of it. It entered on Tuesday at $88. And its stop's been ratcheted twice because of, well, whatever it's seeing as far as the score goes for this trade position. First to 85.38, now to 85.45. So it ratchets these positions in very tiny increments. Now, as a human trader, I would have ratcheted these to the next round number, right? I probably would have ratcheted up to 80. Well, it's not quite. Yeah, I would have ratcheted straight to 86, right? But for some reason, it likes going, well, ratcheting it up what looks like 7 cents, right? So that's not necessarily a ratchet a human would make. I'm not going to make a 7 cent ratchet up, but hey, computers make these minute changes, and that's why we have these agents hired to do this. Now, both of these times, the Kijun line rather than the raw trading formula is what it went by. The Kijun was more conservative as far as numbers on both days. The target sits at 95.41, which is an all-time high, if I'm not mistaken, for Coca-Cola. But that's the standard 8% profit level that we're looking at for the agents to either take profit or ratchet up the stop loss to closer to where the price actually is at that point. It's currently sitting roughly dead flat, just under 0.5% underwater, right? Basically nothing. Earnings have already cleared, so I don't have to worry about that on the horizon. Coke reported a beat on July 28th. Next print isn't till October, so nothing dramatic is going to happen here. Just a clean, patient hold. Not necessarily what I was trying to do with this portfolio, so I had a bit of a conversation on why they picked Coca-Cola. Because it's not momentum-based, it's patience-based, and that's not what this portfolio is doing. So, come Monday, or even maybe tomorrow, if I've got any tokens left, we're going to make a couple of adjustments, right? Remember, we're not looking for patient trades. We're looking for clean signals on momentum trades, regardless of what universe or what sector is in. All right. Now let's make sure I didn't miss anything here for you guys. Checking the chat. We're still here on YouTube. All right, no one's blowing up the chat right now. Thank you for sticking with me. I feel like there's a hair on my face, so excuse me for moving my hands so dang much. But at the end of it, it was more of a, I don't know, why are you being patient, right? That's not what I'm looking for here. But let's talk about the structural move we made. Well, the sleeve that we actually closed. So I sort of previewed on what I did with that firing, basically. But let's talk about the numbers itself. So it launched June 23rd. It had the regular size that I gave each sleeve, right? Nothing new. But it just wasn't functioning. As of today, the sleeve is formally closed, and and all of its capital is reallocated into the wheel engine, like I was talking about already. Options income strategy. Go check it out. It's a good way to generate income off of things you already own. But we raised that strategy's target allocation, so it's roughly working about half the account, right? But it functions because if anybody knows how the wheel works, we know it works. It's not guessing. It's not emotional. It's something that traders have used for a long time to take the emotion out, to bake the profit in. And I'm just having it now be automated. So the vote of confidence the agents had to be like, hey, fire this one, we're going to reallocate it into this sleeve because this is working, is exactly why I programmed these agents to, well, rethink, reshuffle, and adapt to what's happening. And that's why they do weekly updates and they do education. That's why they have leadership, because the leadership stays, but the trading desk evolves, right? So some agents will be fired, some allocation will be moved into a working engine of some sort. And the wheel is what that's going into. It's got a few names, right? It picked Open Door, NIO. It also picked up Nokia, cash secured put. So it hasn't actually picked up the shares yet. So it's I'm forcing it to pick up things that anybody with a modest investment amount, capital, right? Money. I'm just trying not to say money. Money just sounds gross. But capital, right? A modest amount of capital that you can actually still automate it and still create great income without having to be the best trader in the whole world. So picking companies that someone with nominal money could pick challenges this agentic strategy to, well, prove itself. Because I could very well have it pick big names, right? Big companies with easier to trade, easier to understand for the agent's end. But that's not where people start off at. People start off with almost nothing. So I want to help them ramp up that almost nothing a little bit faster, right? Close the gap that automated trading has. And bridge it to the people who really deserve to be using it, which is the people who don't actually know what they're doing and don't have a whole lot of money. Having a intelligent, automated portfolio is, well, one of the best ways to go. Even having it run um, parallel to my trading strategy is it's been working quite well, and it's been a fun project. And I've been very grateful to be able to talk about this project with numerous individuals. We'll get into that when things develop a little bit more, but the conversations I've had about this desk is really kind of helping me not only refine the desk itself, but hearing how people take it, the questions they have about it. It's quite inspiring, honestly. But before we get into deep diving about how cool this is, let's talk about a notable moment from the agents. The honest one here. There's a reoccurring theme in this week's log trades: getting executed correctly, but not always getting logged correctly the very first time. When they pulled the Coca-Cola trigger entry, it didn't write the trade in the log for some reason, despite multiple sessions claiming it had done it. An unattributed IWM hedge that nobody claimed opening at the time. Like, it opened, the agents did it, but for some reason none of the agents could claim who did it. Like, like how is that happening, right? So as this desk evolves and you're hearing me go from a simple strategy and now it's kind of evolving itself over time, now it's having holes, it's dropping trades. And as the human operator here, because, well, I'm the one that needs the profit, not the computer, I need to make sure that it functions correctly. And not logging stuff is not correct. So every one of those got caught and reconciled by a monitoring layer that I designed in, but it still became an issue. That's the system working as it's designed, right? It's filling the positions right, the paperwork just wasn't getting passed through to the logs. And I want the logs because I need the data to be able to track how this functions. This is an experiment, after all, an experiment that I hope helps many people soon, because everybody needs a leg up, and I want that leg up to be, well, money, not just hope and dreams. I want this leg up to work, and I want it to be worth more to you than it does to me. If this works, take the program, put it in your computer, and run with it. I'm not looking to make a dime off of this. The desk itself makes its own dimes. But let's get into what we're watching next week as far as the desk goes. Open Door earnings is Tuesday, so we're gonna have to watch what happens there. Inside the life of this week's, well, new covered call, right? We're gonna see if it's gonna hold that position or it's gonna cut it off before earnings. Nokia cash secured put into August 7th expiry. Assignment or expiration, I don't know. Both outcomes are fine because that's what the wheel is about. We got Coca-Cola holding above its 85.45 stop, basically flat on the week, but the agents are watching that Kijun line. A fresh wheel candidate scan on Monday because there's still sitting capital. And if something works better, it's going to go hunting, right? It's on the hunt, right? It's not always just sitting and waiting. If it has capital sitting and is still above its cash reserve, right, hold some cash back because every, even a super profitable company, if you don't have cash to back up something like a problem, it doesn't really matter how profitable, how good your company is. You're gonna go under. So just like that, the agents also keep a cash reserve too, because you never know what happens. The July jobs report, excuse me, drops Friday, August 7th as well. Non-farm payrolls forecast around 90,000. Unemployment expected to hold at about 4.2%. Now, this dashboard runs 24/7. Well, yeah, 24/5. Because it doesn't need to run on the weekends because the markets are closed. And until I can have it trade, well, tokenized stocks, I don't think it'll be trading on the weekends anytime soon. And it gives me time to conserve tokens, right? I can't just be having the tokens run 7 days a week. That's insane. Because as you guys know, there's some other stuff that's automated too. Some of my promotions, a little bit automated because, well, I can't remember to do it all the time, and sometimes it just needs to go out. Like, I forget to remind you that the show is happening, so there's a reminder that goes out. Thank you to the agents for that, because if I didn't have it go out, I would forget to remind you, and it would be, well, just as empty as it is right now. So, mostly this is, well, discipline. Regardless the fact that there is 0 people in here, the fact that 12 minutes of this show in the beginning was pure mute and I had to come in from behind, and the fact that I was trying to live stream into 3 places and one of those places ended up playing music. That was weird. I need to figure that out as well, but over time we evolve and, well, gremlins happen. Thank you for sticking with me though. Now let's look into what some of the opportunities are for next week. The wheel got some confidence in its vote, right? So half the account is now earmarked for options income and not a small allocation at all. Angle 2, the cloud is still the AI trade the AI trade is still working, is sort of what it's navigating, right? Angle 3, the dividend or the divided Fed means defined risk wins, right? So the agents are taking into account all this. Also, next week, the jobs report come in. So that's what the agents are looking at too. So what the agents are not doing is, sorry, I'm just like, is there more music playing? No. Okay. All right. Cool. Yeah. Now I'm all paranoid that there's random ghost music playing. Okay. So what the agents are not doing is they're not chasing Meta or Apple into next week without a clean AI monetization signal from either one. It's not reactivating the sleeve because why sleeve 2 because it's broken, and it's not forcing new things into current sleeves, right? Because, well, it needs to function first. We need to find functionality in everything before we iron it in. Like the Cairo Securities Agentic Desk is still sort of a lump. It's not a lump of clay. Now I've taken that clay and I've molded it into a pot or a tea kettle or whatever you want to imagine a lump of clay can be molded into. But I haven't fired that clay yet. That clay is still malleable. That clay can still be tweaked, right? I can add handles to this pot if I needed more. I can add a pour spout, right? It's not ironed in. And that's what I'm doing with the agentic desk is I'm making sure that before I fire this fire it in a kiln, but actually iron in its sequences, its system. I want to keep it malleable up until that point. And we got to keep studying it. All right. That was the week that was. Let's close this down for you guys. And for me too, because man, gremlin filled episode. That's what we're going to call this one. Because we've been here a while, we've had the practice, we've gone through these gremlins, and yet one or two still pop up. Here's what I want you to take away from the week, though. The market spent 5 days figuring out which AI spenders it actually believes, and it rewarded the ones who could prove it. Microsoft, Amazon, real cloud revenue, real growth. It punished Beat from Meta because the proof wasn't clean. That's the market maturing, not panicking. We did the same thing, the same sort of exercises in our own portfolios, whether it's the agentic one or my parallel one. It closed what it needed to, it opened what it needed to, it had that hedge return on the FOMC's meeting, 35%. That's great automation. Nothing to scoff at. But none of that was a home run story, just a disciplined one. That's the whole point that's going on today. Even with all the nonsense, even with all of the market going all over the place, did you make money? Did you turn your microphone off of mute? Right? Even with perfectly running machines, you still have caveats. You still have hiccups. And I'm still learning stuff. I'm learning stuff right now as I'm trying to broaden the reach for everybody, because not everybody looks at YouTube, right? So I'm trying to broaden it to X spaces so people can at least listen to the audio. Broaden it to the agentic Facebook page, so that at least the agentic Facebook page can, well, talk to people too, right? We're working it out, because at the end of the day, the most important thing to me is getting the info out to you. Because what's the point of me having all this info in my head under this hat? You are the ones who need it. And I want to share that with you. Now, if you've got questions, ever, right? The chat's open. The comment sections are all open on my videos. I see all of them. Hate mail, happy mail, all of them, right? So please, don't be afraid to leave a comment somewhere. I'll see it. If it takes me a few days, maybe you picked a video that was 6 months old. Try it on one of the more recent ones. But if you need some direct access, yeah, hit me up on X. I'm there. I'm trying to help everybody out there as well, with Robinhood Summit coming up in, well, a month and a half or two or so. We're going to be talking a little bit more about that, right? People want to ask their questions. I got a comment today that I was good at asking a question. It's like, well, the trick is just get your mouth moving, and then find someone close to you in the audience that is on your team. Just when you start to freak out a little bit, because you start to freak out in front of a microphone, naturally, everybody does it. You look to them for a second and be like, all right, cool. That bro's on my team. Thanks, dude. Big fan. Cool. Now I can ask my question. Also, write it down. So I was helping someone with that today, and I'm hoping that Mr. Alvarez can get the courage he deserves to have and ask his question in front of the group, because that's what this is about. There's no enemies in trading. Well, there's no competition. There are a couple enemies. Margin, that's definitely one of those enemies. But as far as competition goes, the only competition we all got is poverty. That's all we're trying to work against, like I say almost every week. We're all a team here as far as traders go. You could be bearish, you could be bullish, you could be piggish, you could be sharkish. But we're all trying to beat poverty, beat going broke, beat not having the life we want, right? So that's what this podcast is for, is trying to help you find tools to create the life that you deserve. And tonight we don't have any questions here on stream, so I won't be taking any questions. But as always, Mahalo for being here and sitting with me in the middle of the Pacific Ocean from wherever you are and whenever you are. This week was heavy. Fed, earnings, um, a real portfolio decision on our agentic end, and you spent your Friday thinking about it with me. Ahui ho. Farewell. Please stay safe. Keep your mental health in check. If you need to, go find a friend or a professional. It's important. Without your brain working correctly, your body doesn't work correctly, and reality doesn't look correct at all, right? Your mind is in charge. So be in charge of it and take care of it. Please enjoy your weekend. I love you guys. Be good. And I'll see you in the markets and on the porch.